Hello guys and welcome to today's YouTube video. You have most likely seen that the stock markets right now are extremely volatile, and you've most likely also experienced a negative return within the last month or so, just like I have. And it feels like that it doesn't really matter where we look, whether it's stocks, crypto, NFTs or whatever it is, then we basically see negative returns all over the place. We also have a high increase in the interest rates, and we have an inflation that is now above 8%, which is actually the highest point that it has been in within the last 40 years or so. And at this point, it seems like the next recession is almost inevitable. In today's video, I'm going to show you some of the studies that has been made around how the stock market is actually performing during recessions. And then I'm going to go over how I'm personally adjusting my own portfolio in order to prepare for the coming recession and hopefully even make a bit of money from it. At this point in time, it seems like a recession is almost inevitable. And the data is also supporting this assumption. Just listen to this. Whenever the inflation has been above 5%, we've always had a recession within the last 70 years, except for one time. And right now we have an inflation that is above 8%. And right now, the inflation is a massive problem for the overall economy. The Federal Reserve is doing whatever they can in order to control the inflation, and they are doing that by increasing the interest rates. However, the inflation is not seeming to slow down, and we are seeing increases in the inflation every single month. Therefore, the chances of a recession is increasing month by month right now. All of this talk about increases in interest rates and inflation and recession basically raises the question of what is actually a recession. And maybe you already know the answer to this question, but there is a lot of people who doesn't know it. And a recession is basically being defined as 2 consecutive periods of negative growth. And the growth is being measured in what is called GDP, gross domestic product. Just have a look at this chart right here from Trading Economics. According to them, the GDP growth was actually negative during the first quarter of 2022. So if this data is actually true, well then we are already halfway through the point where we are officially in a recession. Because now we have the first quarter of negative GDP growth. And as I mentioned before, then all of the existing data there is pointing towards that the probability of a recession in 2022 is extremely high right now. Due to the extremely high probability of us entering a recession in 2022, it becomes very important that you take a look at your current stock portfolio and you evaluate how much risk you actually have in there. I'm now going to go over all of the data there is around the stock market's performance in recession, and then I'm going to talk about what I'm personally doing in order to adjust my own portfolio for the coming recession. If I told you that you should go and invest your money into the stock market right now, then many people would be like, nah, I'm good. I would rather sell all of my stocks right now and buy them back later at a more attractive price. However, it is extremely important to understand how the stock market have historically performed during recessions in order to make this decision. The answer to this did really surprise me, and most likely it is going to surprise you as well. The majority of people would rather sell everything that they have and buy it back later at a more attractive price, which makes perfect sense. However, doing that is actually much harder than you think it is, because you will have to time the market. According to a study made by Russell Investment, which is linked in the description below the video, then we've had a total of 30 recessions between 1869 and 2018. And 16 of these recessions actually had a positive stock return from when they started to when they finished. The recessions with a positive stock return lasted on average 16 months, and they provided investors with a return of 0.6% to 38.1%, with an average return of 9.8%. And that is even though the GDP was down by 3%. That is completely insane and doesn't make any sense at all. Because when the overall economy is going down, you would expect that the stocks are going down as well. Out of the total 30 recessions, we had 16 with a positive stock return, which also means that we had 14 with a negative stock return. The recessions we've had where the negative stock return lasted on average 18 months and provided investors with a negative stock return of minus 14.2%. All of this information actually means that selling all of your stocks and buying them back later might not be the best idea, because you essentially have no idea of whether you're going to lose money or make money from a recession. This does of course raises the question of what should I do now? And the answer to this question is extremely difficult to give you. However, I am now going to go over what I'm personally doing with my own investments. I personally think that a lot of the negative news about the inflation, the interest rate, the coronavirus effects, and the current war between Ukraine and Russia is already priced in within the markets. Out of the mentioned factors, I do think that the biggest risk factor there is when it comes to increasing the probability of a recession is increases in the interest rate. Therefore, I am basing my portfolio based on stocks that are not sensitive to changes in the interest rate. And these companies that are less dependent on the interest rate are, of course, the older companies that are very, very safe and very mature companies. And it is also these companies that are paying a really high amount of dividends every single year. It doesn't really matter what happens in the market, then these companies are still making money. This could be companies like banks, it could be a company like Coca-Cola, it could be companies within construction, for example. It could also be medical companies, because no matter how bad the economic situation is, well, then people are still going to buy medicine, which means that medicine companies will also have a really good cash flow during bad economic times. Therefore, I'm buying these. And what I'm replacing these old and boring companies with is essentially my really interesting high-tech companies. The majority of interesting high-tech companies does right now have a really high market valuation. And these companies are really dependent on the interest rate, because when you are a younger company and you need to grow, you are dependent on capital. And when the interest rate increases, well, then does the cost of capital basically increase as well, because it becomes more expensive to borrow money, which essentially means that these companies are now spending less money than they, in my opinion, should on growing, and therefore it does hurt their valuations as well. We always see that these companies, small companies with high valuations that are very dependent on interest rate, they are the ones getting hit the hardest. Therefore, I have reduced my overall holding of these companies and moved into more safe choices, I guess you can say. However, I'm still buying every single month, and the majority of my money is still in the S&P 500 index, and it will continue to be so. I'm not going to sell any of my stocks or anything like that. I'm going to stay invested. I'm going to keep on investing into the market, no matter what happens with the inflation or with the interest rate, because I do believe that the biggest mistake you can do is selling all of your stocks and go out of the market. That was basically all I had in today's YouTube video. I really hope that you liked the video, and if you did, then please press the like button below the video and subscribe to my channel if you want to see more videos like this one in the future. Thank you for watching, and see you in the next video.